welcome to this explainer. Today, we're embarking on a journey through financial history to explore a profound transformation, one that might actually be reshaping the very architecture of global finance. You see, when we look back through time, we find that every advanced civilization, no matter how complex or sprawling it is, relies on one invisible foundation. It's a foundation that often goes completely unnoticed in our daily lives, and yet it literally dictates the rise and fall of empires, the success of innovations, and the prosperity of future generations.
Every civilization, no matter how advanced, has been built upon one invisible foundation. Take a moment to let the gravity of that thought settle. We often assume that the bedrock of our society is our technology, our political systems, or, maybe even the everyday money in our pockets. But history tells us a different story. That invisible foundation isn't technology, it's not politics, actually it's not even money. It is capital.
Part 1. The evolution of capital. Throughout history, civilizations have relentlessly accumulated capital, protected it, and, sometimes even fought wars over it. Kings stored it away inside heavily fortified vaults, and merchants crossed vast, dangerous oceans just to acquire it. But why? Well, because capital has always represented something much larger than just wealth itself. It represents the profound ability to survive periods of deep uncertainty. It's the essential lifeblood required to finance new ideas, to build tomorrow, and to create lasting generations of prosperity for all of us. You see, every era discovers its own preferred form of capital. In agricultural societies, the ultimate capital was fertile land and livestock. Then, during the Industrial Revolution, it shifted to factories, heavy machinery, and infrastructure. And in our modern era, we accumulate government bonds, corporate equities, and prime real estate. So the physical form of capital has constantly evolved over the centuries, but its function never changes. The world's most trusted capital is always the asset that people believe will preserve value across decades, not just months. Which brings us to a really fascinating reflection. For the last century or so, that foundation has largely been built upon sovereign debt, real estate, and gold. Yet over the past 15 years, a new digital asset has quietly entered the global financial system. Initially, it was dismissed as just internet money and then labeled a speculative bubble. But now it's slowly being viewed through a much longer historical lens. Institutions are beginning to ask a very different question. Can Bitcoin become capital?
Part 2. Money versus capital.
Now, most people use the words money and capital interchangeably, like they're the exact same thing, but they're not. Consider the business of shipbuilding. A business receives payments every single day. That cash, that money, is what keeps the daily operations running. It pays the workers' salaries and buys the wood they're shaping today. But the underlying shipyard itself, the highly specialized machinery, those productive assets that generate income for years to come, those represent true capital. So the crucial point to take away here is this deep dichotomy. Money exists to move. Its whole purpose is to facilitate exchange. Capital, on the other hand, exists to remain. It enables production. Money buys today's goods, while capital finances tomorrow's opportunities. During periods of uncertainty, people might actually spend their money faster, but they protect their capital even more carefully, because capital is designed specifically to survive tomorrow's unknown. For years, people debated whether you could use Bitcoin to buy a cup of coffee, essentially treating it as everyday money. But history suggests that the assets that truly shape civilizations are rarely the ones we exchange every single day.
Part 3. The digital gold standard.
For thousands of years, physical gold functioned as everyday money. It circulated freely in markets, it paid soldiers, and it bought goods. But as commerce expanded on a global scale, moving physical gold around became an absolute logistical nightmare. Verifying its purity was slow, and securing it was incredibly expensive. So gold's role had to evolve. Instead of circulating in the streets, it retreated into heavily guarded central bank vaults. It made this massive shift from being everyday money to becoming a foundational reserve asset sitting quietly in the dark, supporting the paper currencies built on top of it. Gold didn't become less valuable, it became more fundamental. Now, history never offers us any guarantees. However, institutions are closely exploring Bitcoin because it theoretically solves the exact logistical and geographic challenges that forced physical gold into those vaults in the first place. Think about it. Its ownership can be verified globally within minutes, custody is secured through cryptographic keys, completely removing the need for armored trucks, and its supply follows transparent mathematical rules rather than geological luck. So it's increasingly being evaluated not as speculative internet money, but as a potential form of digital capital for a digital civilization.
Part 4. Bitcoin is becoming collateral.
Every functioning financial system depends on assets that inspire profound confidence. Just as historical records of wealth are carefully examined by researchers, market participants across generations evaluate exactly what assets they truly trust. The strongest asset isn't defined simply by what it is, but by what people are willing to build upon it during times of intense stress. And this introduces a really vital concept for us to grasp: collateral. Collateral is the fundamental asset that transforms wealth into productive capital. It's the engine that allows families to buy homes, businesses to borrow capital, and banks to create credit. Without trusted collateral, modern finance simply cannot exist.
Observing the market today, we're seeing a fascinating maturation taking place. For a very long time, Bitcoin was treated almost exclusively as a short-term speculation. But gradually, we're seeing a new utility emerge. Individuals are now borrowing against it without having to sell it. Public companies are actively holding it as a treasury reserve asset. Institutional custodians are securing billions in value, and entirely new financial products are being designed around holding it long-term. It's increasingly being utilized as a deeply liquid, foundational layer of collateral.
Part 5. Building a new financial layer. I want you to consider the evolution of a financial system as being remarkably similar to the building of a modern city. You have to begin with the foundations. Then you lay the roads, construct the buildings, and finally build out the sprawling infrastructure of a modern metropolis. The absolute strongest and most vital layers of this city are the invisible foundations dug deep into the earth. Well, the financial world works exactly the same way. The strongest layers are rarely the ones people notice on a daily basis. They're the ones quietly supporting everything above them.
We can actually observe how this builds a potential digital finance stack. Down at the base foundation, you have the digital asset itself, Bitcoin. Then, built directly upon that trust, you have institutional custody to protect the wealth. Once that's secure, credit markets emerge, which allows capital to mobilize. Above that layer, exchange-traded funds expand access to global investors. And right at the top, decentralized finance introduces programmable lending and settlement. The key takeaway here is that each new layer relies entirely on the trust, the liquidity, and the stability of the layer beneath it.
Part 6. The foundations of tomorrow. Of course, history, the markets, and society will ultimately decide if this new digital foundation endures. But what really matters today is recognizing this profound shift in the conversation. We're witnessing a transition from viewing this asset merely as a speculative investment to evaluating it as core infrastructure. It is genuinely being looked at as a foundation upon which entirely new financial systems might be constructed for the future. Every generation inherits a financial architecture, but only a few generations get to witness the construction of a new one. Money facilitates exchange. Capital enables civilization. Understanding the fundamental difference between those two ideas may be one of the most important financial lessons of our time. So, as you look ahead, consider not just where wealth is moving today, but what kind of invisible foundations are being laid to create the prosperity of tomorrow. Will this new digital architecture ultimately become the bedrock of the 21st century?